How's it going, guys? Karlton Dennis here, and welcome back to Taxes Made Simple. Today's video, we are outside, changing it up from my studio, and part of the reason why is because I am getting a lot of your guys' questions, so I figured why not do some Q&A on the iPad outside. It's a beautiful day here in Southern California. Your questions have been coming in, and I'm ready to answer them, so let's dive in. All right, first question. Big question, Karlton. What do you think about nonprofits? I'm thinking of opening one, but need to know more about the cons. Thank you. This is from Lamb Multi-Services. So, big fan of nonprofits. Part of the reason I'm a big fan of nonprofits is because a majority of taxpayers who I work with get to a point where they want to be philanthropic. And if you're somebody who is open to being philanthropic, then you can also receive some tax benefits at the same time. When you get to a point where you would like to be philanthropic, you can choose to donate yourself to other charities, or you can choose to start your own charity or foundation. Majority of my tax clients start foundations because you can roll over 30% of your AGI and receive a tax deduction for it. One of the benefits to having a foundation is that 5% of the foundation's value at year end has to be donated to a qualifying 501c3 of your choice, another foundation, or you can donate it to any cause that you deem reasonable that is a qualified cause within the foundation requirements. So a lot of people love this control that foundations give them. There's less scrutiny when having a foundation as opposed to having a nonprofit. There's just some more hurdles you have to jump through, but both are non-for-profit. I'm a big fan of them, and it's definitely something that you should be considering as a part of your wealth building. All right, this is a good one. This came in from Kimberly Butler. Kimberly Butler asks, does rental arbitrage qualify one as a real estate professional? Kimberly, that's a great question. The reason why rental arbitrage would not qualify you as a real estate professional alone is because rental arbitrage means that you're renting out someone else's space. And if you're renting out someone else's space, you're not on title, which means you have no ownership of the property. Now, when you're qualifying for real estate professional status, the goal is so you can turn your passive losses into non-passive losses. That way you can offset all of your non-passive income. W-2, 1099, stocks, day trading, crypto. These are all non-passive forms of income. But if you're qualifying as a real estate professional through rental arbitrage, the hours that you spend in real estate related activities, such as your real property trader business, would go towards you materially participating if you had your own rental property that you were qualifying to be a real estate professional on. And if you don't own your own investment property, whether under an LLC or under your own personal name, then no, you cannot qualify for real estate professional status to use your passive activity losses if you do not have a rental. All right, guys, this is a great question. Probably a question that many taxpayers have when they watch my videos. This comes from Jake Whitman. Jake said, hi Karlton, I just went through this video, very good information. And one quick question I have is my LLC, it's set up to be taxed as an S-Corp. Would I still get the same benefits as an S-Corp, or do I need to change it over completely? Thanks. So Jake, great question. Probably a question that many taxpayers are having right now is if they have an LLC and switch it over to an S-Corp, is it the same as if they would have just set up an S-Corporation initially? The answer is yes. You have the same type of protection from a liability standpoint. You have the same filing requirements by filing your tax returns March 15th. You still have to run payroll for yourself. You still get to use the same bank account, and you share the same EIN number that you set up when you had your LLC. When you switch over to an S corporation, S corporations have different compliance requirements than LLCs. And one of those compliance requirements is completing your corporate minutes. This is done by all S corporations who start out as S corporations and is something that is done every other year for LLC owners that are taxed as S corporations. So your annual minutes have to be submitted. Other than that, all things are remaining the same. You are taxed as an S corporation, but you're truly an LLC. This is a funny one. This one's from Kyle Alane. Kyle said, if I win the lottery, can I put the winning ticket into an LLC so I can pay less taxes? That's creative. Kyle, unfortunately, when you win the lottery, you're given a W-2G. A W-2G is almost like you working for an employer, except the employer you're working for is like a gambling corporation, right? So they're giving you a W-2 based on your gambling earnings. And the gambling earnings have taxes associated with them, federal and state taxes, as well as Social Security and Medicare taxes. Most cases, you can have these taxes withheld when receiving the W-2G Sometimes you're receiving the gambling earnings without any taxes being withheld, and you as a taxpayer are responsible for paying those taxes come April 15th. So the answer is no. Unless you're a professional gambler and you're doing it for a living, then you can allocate that income into an LLC. If you just happen to win gambling, you're paying taxes, brother. So I got another one coming in from Vanessa Talavera. Vanessa says, I'm starting a small mobile teeth whitening business and am wondering, should I start a sole proprietorship, LLC or S-Corp? I really don't see myself making more than 40K. I really just need some income to get me by and save a little, but I need the flexibility this will allow me. So I'm pretty sure most of you guys who are following can answer this question for Vanessa. I'm a big fan of separating your liability from yourself, especially if you're going to be operating on somebody's mouth. I know when I went to the dentist, I never left out of there without at least some blood coming from my teeth. And I always thought about it and I was like, dang, I really wish these dentists didn't come in so hard at me if I had it my way. Ugh. And what if somebody decides to sue you, Vanessa? You would be hoping that you had an LLC in place, right? That's exactly why I'm recommending an LLC. When the time comes and you decide to pour in a little bit more into your business and things start to grow and you're doing over $40,000 net income, this is when you will start to look at the S corporation as a means for you to switch over so you can start taking payroll, pulling money out of your business, and actually receiving a tax deduction at the same time. Great question. Okay, so this one came in from Joshua Centers. What if I have an S-Corp doing between 600 to 1 million a year? I started another business as an S-Corp and wondering if I should have it own the other. So Joshua's probably thinking about having either a parent company or a management company. And he's wondering, does it make sense to have an S-Corp when you're doing 600 to 1 million a year? So when you think about this question and you think about the way the taxes are set up for an S corporation, two things come to my mind. Is Joshua constantly doing 600 to 1 million a year? Is that the net income? Because let's just say it's the net income. If you're doing 600 to 1 million a year net income after all expenses, you're making millions, brother, which means you're up there. And typically, a lot of my taxpayers outgrow the S corporation after they're doing about $500,000 net income. This is when we start to look at the C corporation, because the C corporation only comes with a 21% federal tax rate. You see, when you're an S-Corp, everything is flow through income, so it all flows over to your personal taxes. And even though you're receiving a payroll deduction, sometimes receiving a payroll deduction plus having all this income coming over to you still puts you into the highest tax bracket, 37%. If you tack on the state of California, that's an additional 13.3%. You're looking upwards to 45, 50% in taxes. So for a taxpayer who switches over to the C corporation, you're at a permanent 21% federal tax rate. And then if you decide, you can either take a loan and loan money to yourself, which is tax-free from a C Corp. C corporations are able to take loans, or you could choose to take payroll, which would be taxable, but only in amounts that you need. Have a S corporation manage your C corporation, have your C Corp pay management fees to your S Corp, so they record a tax deduction based on that transaction. Your S corporation is the company that you will draw payroll out of, and then you can do your own retirement planning up inside of the S corporation instead of the C Corp where you have all your employees. Just other ways to think about this. There's tons of ways you can think about it. I would personally need more information. I would first need to know if that income that he's sharing with me is the net income, and I would need to know if it's consistent or not. But that's a way in which we can definitely transition. This is a good one. Jules W. I have a feeling you're not asking this for a friend, so we're gonna answer this as if it was you. Silly question. If I have an S-Corp and only pay myself once at the end of the year, how do I pay my monthly bills? Asking for a friend. Emoji. All right, Jules, that's not a silly question, and probably a question that other people are thinking about when they watch my video where I said you only have to do payroll once a year. I want you to know that when you're a business owner, you have full control over your bank account, which means you get to determine when you want to take distributions, which is just moving money from one hand to the left. But if you take a distribution, the distributions need to be tracked throughout the year. So that way, when you do process that one payroll at the end of the year, that you're processing it based on the amount you actually paid yourself in distributions. Let me give you an example. Let's say my business made $100,000 in the tax year of 2022, and I took out $50,000 in the year of 2022 because I needed to pay my bills, I needed to live, I needed to cover my car rent. Well, these are items that I have to cover, and if I don't take the money out of the business, I'm screwed. So if I live off of this money, that's completely fine. I can take the distribution tax-free up front. I'm still gonna have to pay payroll taxes on this money though, and federal and state taxes when I process payroll. When you process payroll, you're paying into Social Security and Medicare tax. You can do this at the end of the year in December. In the payroll processing, you can determine whether or not you want your federal taxes and your state taxes withheld based on the amount you paid yourself. So if I paid myself $50,000, I know I only have to pay Social Security and Medicare tax on that amount come time of payroll. But when I file my tax returns for my S-Corp and I pay my individual tax returns, I'm gonna have to pay taxes, federal and state, on the 50 grand I took, which was W-2, and the other 50 grand that I had inside of my business, which was business income. So I'm still gonna be taxed on the full $100,000. The $50,000 though is taken as a deduction from my business when I take payroll. The key point here is that you only have to take payroll once if you want to, and you can take distributions throughout the year in order to live. This is a great question from Anya Juarez. Anya says, what if my buddy and I are in business together and he has an LLC, I'm just a manager? Can child support look into what the business account has in it? Or will they only go off of what my buddy is paying me from the business? Okay, Anya, this is a great question. So if you're somebody that's on child support, typically you're receiving your child support amount based off of the income that shows up off of your tax return. So if you're only reporting a certain level of income, then that is what the government, the system, the program that is qualifying you for child support is looking at when making this qualification. Now, if you're not an owner under the business and you're just getting paid as a manager of the business and you can see into the business's bank account, that's fine. That's what a manager does. But you're an employee, so you're just getting paid. So no, child support cannot come after the owner of the business to tell you to tell the owner to pay you more so you can end up paying more into child support. Or no, they can't look at what the business is making, and even though you're managing it, determine that you can afford more. If you're getting paid a certain amount, that amount is what you have deemed as what you're living off of and what you're filing tax returns off of based on all circumstances. And then based on those circumstances is how they determine your child support. So I hope this answers your question, Anya. That's a great question. If you have any other questions, like many others, you're more than welcome to schedule a consultation with my office. I enjoy doing Q&A, but I also enjoy chatting with you guys. And if you guys would like to schedule a consultation, feel free to visit the link below. I look forward to seeing you guys on the next video. Take care.